So US bank earnings calls have been going on over the last couple of hours. Bank of America now taking questions from analysts. What are they saying? Let's find out. Bloomberg's Wall Street reporter Sonali Basak has been, as ever, listening in. What are they talking about, Sonali?
A few things to keep an eye on here, Guy, and it's how do they make money moving forward, which is for Bank of America, JPMorgan, there's a lot of focus on the consumer still being pretty strong through this environment. Bank of America is saying that you're even still seeing consumer spending consistent with a 2% growth environment and low inflation. So with that said, it's credit cards, it's the credit card businesses, which is why you're seeing them kind of shake off this idea that charge-offs are rising a bit and provisions and reserves are rising. Reserves are building, those provisions for loan losses are rising. I will also say, if you think about just how sluggish the last year was for investment banking, you have to think at this point the only way to go is up. You have in the hundreds of millions some businesses. For equity underwriting at Citigroup, for example, less than $150 million. I mean, these are kind of peanuts for these banks if you think about how sluggish the business has been. For that number in particular, down 68%. These numbers are down more than 50% for almost every single business line. So that is somewhere where if you look at JPMorgan, who says not only is the pipeline coming back, it's challenging still to convert those, but the pipeline is coming back. They're also open for business with leverage finance. I think this idea that the banks want to take on some risk in this environment despite what their view is on the macro is a very important dynamic when we think about the uncertainties of the year ahead.
Based on the individual businesses of all these guys so far, who is best to capitalize on that? An okay consumer with some clouds, an investment banking bottom, and a trading arm that's still super solid and taking on more risk. Who has the runway?
I think you have to look both at JPMorgan and Citigroup for two different reasons. One of them being that both of those fixed income businesses are simply massive. Bank of America showed the biggest percentage jump increase, but remember, they had a somewhat smaller base that they were going off of when you looked at their fixed income business. You had more than $3 billion, 3.78 at JPMorgan that was a miss, but at Citigroup you had a huge beat, a record really performance there, stunning really. And what it also shows you when you look at the value at risk rising for JPMorgan, again, they are willing to take on risk. Markets are still volatile. It's going to be interesting to see, as we've been talking about all year, how the rates, currencies, commodities, businesses start to fuel these businesses moving forward. Jane Fraser in particular in her statement pointed out that what she's trying to build is, again, a bank that is good in many different environments. Huge card business, huge trading business, and I've got to say the other thing that's kind of on their side here is the fact that the valuation has plunged just so far for Citigroup. They're trading at half their book value just about, and they're still saying that their phase 2 of their turnaround plan doesn't even start until as early as next year. So they're early in this turnaround story, but those businesses are the ones that both JPMorgan and Citigroup in particular can lean into.